Folks, if you have a student loan, there is a very good chance your balance is higher today than when you graduated. Not because you missed payments, not because you borrowed more, not because you did anything wrong. Because the system was specifically designed to make that happen. Here is a sentence that the United States Department of Education actually wrote in an official government document. Interest capitalization, quote, serves no purpose other than to generate additional interest income. That is not a critic of the system. That is the system describing itself. The mechanism that causes your student loan balance to grow, even when you make every payment on time, was acknowledged by the government agency running the program as having no purpose beyond extracting more money from borrowers. Today, we are going to expose exactly how this system was built, the specific mechanisms that make balances grow instead of shrink, and the 4 moves that let you fight back against a system that was not designed with your payoff in mind. Here is the experience that 43 million Americans share right now. They graduated, they got a job, they started making payments. And then, months or years later, they checked their balance. And it was higher than when they started. The average borrower who graduated with federal student loans in 2026 is carrying an undergraduate loan rate of 6.52%. Graduate students face 8.07%. Plus loan borrowers, often parents, face 9.07%. At those rates, interest accrues every single day. Not monthly, every day. And the moment any of those borrowers enter a period where their payment does not fully cover the daily interest, which happens automatically during school, during grace periods, during deferment, during income-driven repayment plans where the payment is too small, that unpaid interest does not simply wait. It capitalizes. It gets added to the principal balance. And then it starts accruing interest itself. You pay interest on interest. Your balance grows, and the clock resets from a higher starting point. This is not a side effect. This is a feature. Federal student loans were officially created by the National Defense Education Act of 1958, signed into law by President Eisenhower in response to the Soviet Union's Sputnik launch. The original concept was straightforward. The government needed more scientists and engineers. Loans would make college accessible. Students would graduate, earn more, and repay the government. The Higher Education Act of 1965, signed by President Johnson, expanded the program dramatically, making loans available to a much broader population and establishing the interest rate formula tied to the 10-year Treasury note that still governs rates today. Here is where the story turns. In 1972, Sallie Mae was created as a government-sponsored enterprise to buy student loans from lenders, creating a secondary market for the debt. Banks could make loans, sell them to Sallie Mae, collect fees, and immediately make more loans. Their exposure to whether students actually repaid became secondary to the volume of loans originated. Remember that government admission that interest capitalization serves no purpose other than to generate additional interest income? Here is the context that makes that admission even more significant. Interest capitalization was not designed by accident. It was structured into the repayment system at a time when the primary financial incentive in student lending was volume and interest revenue, not repayment outcomes for borrowers. Sallie Mae was privatized in 2004. The government-sponsored entity that had been buying student loans became a fully private corporation, now called Navient, whose entire business model depended on borrowers being in repayment for as long as possible. A loan paid off quickly generates minimal interest revenue. a loan that capitalizes, grows, and takes 20 or 30 years to repay, generates multiple times the original principal in interest income. The financial incentive was never for you to pay it off fast. It was for the balance to stay as large as possible, for as long as possible. Name each mechanism clearly and specifically. Here are the 3 specific mechanisms that cause student loan balances to grow, even for borrowers who are doing everything right. Mechanism 1. Interest accrues from the moment money is disbursed. On most federal student loans, including unsubsidized loans for undergraduates and all graduate student loans, interest begins accruing the moment the loan is paid out. Not when you graduate, not when your grace period ends, the day the money arrives in your school account. A student who takes out an unsubsidized loan in freshman year and does not make any payments during school accumulates 4 years of accrued interest before making a single payment. That interest then capitalizes, gets added to the principal the moment repayment begins. A $20,000 loan with a 6.5% rate accumulates over $5,000 in interest by the time a typical 4-year student graduates. Their repayment starts not at $20,000, but at $25,000. Mechanism 2. Income-driven repayment plans can make balances grow during repayment. Income-driven repayment plans calculate your monthly payment based on your income. For lower earners, that payment can be significantly less than the monthly interest accruing on the loan. Every dollar of interest your payment does not cover gets added to your balance, monthly, reliably, for as long as you are on the plan with a payment below the interest threshold. Borrowers who spent years on income-driven plans have frequently discovered their balance is larger after a decade of payments than when they started. This phenomenon, called negative amortization, is so well documented that the new RAP plan that launched July 1st specifically eliminated it by waiving uncovered interest entirely. Mechanism 3. Default resets the clock from a worse position. Pew Charitable Trust's research found that 34% of federal student loan borrowers default at least once. Of those who default once, 66% default again. 2/3 of people who default twice. Because the consequences of default, wage garnishment, tax refund seizure, credit damage, are so severe, many borrowers exit default through rehabilitation programs that allow previously accrued interest to capitalize onto the principal one final time. Their starting point after default is higher than it was before. Each of these 3 mechanisms, accrual before repayment, negative amortization during repayment, and capitalization after default, stacks on top of the others. A borrower who experiences all 3 can end up owing significantly more than they ever borrowed, decades into a repayment journey, having never missed a required payment. Here are 4 moves that directly counteract the mechanisms we just walked through. Move 1. If you are still in school, make interest-only payments right now, even small ones. Paying even $25 to $50 a month toward the interest on unsubsidized loans while you are still enrolled prevents that interest from capitalizing when repayment begins. It is not glamorous. It does not reduce your principal, but it prevents your starting balance from being inflated before you even begin. Move 2. Choose your repayment plan based on your total interest cost, not just your monthly payment. The RAP plan that launched July 1st eliminates negative amortization by waiving any interest your payment does not cover. For borrowers on older income-driven plans where balances have been growing, switching to RAP stops the bleeding. Run your specific numbers through the Department of Education's loan simulator before deciding. Move 3. Void deferment and forbearance unless you have no alternative. Both pause your payments, but neither pauses interest accrual on most loan types. Every month in deferment or forbearance is a month of interest that capitalizes when you re-enter repayment. If your income is genuinely low, switching to an income-driven plan with a payment of $0 is almost always better than forbearance because it stops the capitalization clock while preserving your IDR payment history. Move 4. And this is the one with the highest long-term impact for anyone with the financial flexibility to do it. Make extra principal payments whenever possible and designate them explicitly as principal. Most loan servicers apply extra payments to future interest first, unless you specifically instruct them otherwise. When you make an extra payment, contact your servicer and request that the overage be applied directly to principal reduction on the highest interest loan. This is not automatic. It requires an explicit instruction, but it is the fastest way to reduce your balance and the total interest you will ever pay. The student loan system was not built in bad faith from day one. It was built to solve a real problem, making college accessible to people who could not otherwise afford it. But over 60 years of legislative changes, privatization, and financial incentive structures, it evolved into a system where the mechanisms that generate the most revenue, capitalization, negative amortization, default cycles, are the exact same mechanisms that cause borrower balances to grow instead of shrink. The Department of Education's own language described one of those mechanisms as serving no purpose beyond generating interest income. Now you know which mechanisms those are, and knowing gives you the ability to route around them. Here is what was hiding inside the system. Interest accrues from the day money is dispersed, not from graduation. Income-driven repayment plans can grow your balance every month if your payment is below the interest threshold. Default capitalizes all accrued interest onto your principal and resets the clock from a higher number. And the Department of Education itself admitted that capitalization serves no purpose beyond generating additional interest income. Your 4 moves. Make interest-only payments while still in school to prevent first-day capitalization. Choose your repayment plan based on total interest cost, not just monthly payment. Avoid deferment and forbearance. Switch to a zero-payment IDR plan instead. And explicitly designate any extra payment as principal reduction on your highest interest loan. The system was not designed to make paying off your student loans easy. But it was also not designed expecting that you would understand exactly how it works. Now you do. If this video exposed something about your student loans that nobody ever explained clearly, hit that subscribe button. Every week on First Million Club, we pull back the curtain on exactly how the financial system works, so you stop being surprised by it and start being prepared for it.